This is Barry Zalma speaking for Zalma on Insurance at YouTube. I am a lawyer who is retired from the practice of law and now spend my time working as an insurance consultant, insurance claims handling consultant, and expert witness. I'm also an author of several books, including one on the California Fair Claims Practices Regulations. These are regulations that have been adopted in most states in various forms, probably the most strict of those forms being the California regulations. If you comply with the California regulations, you will probably be complying with the regulations in every other state. The California Fair Claims Practices Regulations set forth standards for the handling of insurance claims. They are not intended to be a text on the handling of insurance claims that must be followed slavishly. They do not even claim to be a complete guide to claims handling. The regulations are rather an outline of basic claims handling techniques. Minimum standards are not maximum standards. The California Department of Insurance expects the insurers doing business in the state to treat their insureds with good faith and fair dealing, far in excess of the minimum standards established by the regulations. They were put in place for the sole purpose of allowing the Department of Insurance to enforce California Insurance Code Section 790.03H as required by the California Supreme Court. Insurers with a professional claims staff will consider the regulations a starting point from which their dedication to serve those they insured will grow. If, as some may desire, the regulations are considered maximum requirements, the insurer will find itself in court fighting a suit claiming breach of the covenant of good faith and fair dealing. As minimum standards, the regulations should teach insurers that they need to train their claims personnel to treat those they insure better than the regulations require. Although the training required by the regulations is compulsory, every year no later than September 1, the prudent insurer will see the training requirements as a benefit to the insurer. The insurer may use the training required by the regulations as a starting point to develop a more professional claims staff ready to provide every insured who presents a claim with excellence in claims handling. There is no downside to a thoroughly and competently trained claims staff. The competent claims staff that, in addition to knowing the requirements of the regulations, is also able to resolve claims presented to the insurer in a professional, competent, and fair fashion. Before one can even begin to comply with the task of fulfilling the requirements of the regulations, the claims person needs a basic understanding of first-party and third-party liability insurance. Such an understanding of insurance requires first to understand the importance of how insurance is obtained. For example, the prospective insured's first contact with an insurer is a meeting with either an agent, a sales agent of the insurer, or a broker. When meeting with an agent, the prospective insured must understand that an agent is a person appointed by the insurer to transact insurance business with and on behalf of the insurer. The agent often has the right to effect insurance in the name of the insurer without first obtaining permission from the insurer, since the insurer has given the agent a blanket right to write and start various types of insurance like auto insurance or homeowners insurance. The prospective insured presents his or her needs to the agent, who will either accept or reject the proposed insurance terms. If the terms of the insurance policy are accepted, the prospective insured immediately becomes an insured of the insurer. When dealing with an insurance broker, the prospective insured must understand that an insurance broker, unlike an insurance agent, transacts insurance with but not on behalf of the insurer. The broker's only duty is to the prospective insured, and he or she shops for the broadest coverage available at the lowest price. The broker cannot bind an insurer without first obtaining the permission of the insurer. The broker will first obtain from the insurer a binder or a commitment in writing to insure the potential insureds. Brokers will often charge a brokerage fee for their services, since their commission may be smaller than that received by an agent, or the broker may be required to split the commission with an agent of the company. The broker who charges a brokerage fee must advise the prospective insured of the fee and the reason for the fee. Sometimes insurance is written by what is known as a direct writer. Some insurers who issue direct writing policies like Geico refuse to deal with agents or brokers. They will accept proposals for insurance directly from a prospective insured who will speak, usually by telephone or through a website, with an employee of the insurer who has the authority to accept a particular risk. A commission from the insurer compensates both the agent and the broker. The direct writer, on the other hand, simply pays a salary to its employee who accepts risk directly from the prospective insured on behalf of the insurer. The person making a decision to accept or reject a policy of insurance is known as an underwriter. These are, in the commercial world of insurance, different from the original underwriters at Lloyd's who actually put their own money up to take a particular risk. The modern underwriter working for an insurance company is the person who makes the decision to insure or not insure a prospective insured. The underwriter almost never communicates with the insured directly, but only communicates with the insured through the agent or the broker. The underwriter is the risk taker. He or she makes a decision whether risk presented by the broker or agent is the type of risk that the insurer is willing to take. Each insurer has a different criteria and different underwriters who look at risk differently. The agent, if a representative of more than one insurer, and the broker try to present the risk to an insurer and underwriter best suited for the risk. When insurance began at Lloyd's in London, the underwriter was the person who took the risk with his or her own funds. The modern underwriter only takes the risk for his or her employer. If you wish more details about this situation raised by the California Fair Claims Practices Regulations and how insurance works in the modern world, consider purchasing from Amazon.com my book on the California Fair Claims Practices Regulations. I have other books available at the Insurance Claims Library, which can be found at my website, www.zelva.com.